September 2020. The U.S. Department of Justice files criminal charges against JPMorgan Chase, wire fraud, market manipulation. The headline number? $920 million, a record fine. But the headlines missed something larger and quieter. While the bank paid that penalty, it was also sitting on roughly 750 million ounces of physical silver, nearly a year's worth of global mine output. The story begins on a trading floor. In March 2008, JPMorgan acquires Bear Stearns in the middle of a financial collapse, and with that acquisition comes a massive short in COMEX silver futures. The position was dangerous. If silver spiked, losses could be catastrophic. At the center of the desk were two men, Michael Nowak and Greg Smith. Prosecutors later say their team executed tens of thousands of trades following a single pattern, a technique known in the trade as spoofing. The mechanics are simple and ruthless. Show a wall of selling to trick algorithms into moving the market, then pull the order and take the other side at a better price. Algorithms front-run the fake supply, prices slip, the spoofing order disappears, profit is taken. Regulators found the pattern repeated across years. Internal chat logs, the sort of offhand messages that traders forget are recorded, referenced phrases like, "just get spoofy" and "painting the tape." Then the position pivots. After silver's volatile run in 2011, the inherited short became a liability. JPMorgan did something most large traders do not do. It began taking physical delivery. The bank opened its own COMEX warehouse, and over the ensuing years, it amassed an astonishing hoard of metal. Public estimates put the accumulation in the hundreds of millions of ounces, a web of holdings spanning COMEX warehouses, SLV custodial balances, and allocated accounts in London. Over time, the bank's position flipped from one of the market's largest shorts to possibly the largest long in history. Investigations followed. The CFTC began digging in 2018. The FBI layered on surveillance. Algorithms designed to detect systematic spoofing flagged repetitive patterns. On September 29, 2020, JPMorgan entered a deferred prosecution agreement and admitted to wire fraud tied to conduct between 2008 and 2016. The total settlement? $920 million, including criminal penalties, victim restitution, and disgorgement. The human consequences reached further. In 2019, indictments named Nowak and Smith under RICO, the Racketeer Influenced and Corrupt Organizations Act, and by mid-2022, juries found them guilty. Sentences followed the next year. Meanwhile, the physical market was changing in ways few anticipated. In 2020, the silver market showed a surplus. By 2021, deficits appeared. Then the gap widened sharply. 2022 registered a record shortfall. Year after year, from 2021 through 2024, above-ground inventories were drawn down. Cumulative deficits began to approach the very magnitude of the metal JPMorgan had amassed. Two structural forces drove the imbalance. First, solar photovoltaic manufacturing. New cell technologies adopted globally consumed far more silver per watt than older designs. The industry alone used hundreds of millions of ounces in recent years. Second, the electrification of transport. Electric vehicles use significantly more silver in their electronics than internal combustion cars, and policy mandates across regions locked in continuing demand growth. The result, registered COMEX silver fell from roughly 150 million ounces in 2020 to under 60 million by late 2024. Supply was being drained. A conflict emerged in plain sight. JPMorgan served as custodian for the iShares Silver Trust, SLV, the world's largest silver exchange-traded fund, responsible for hundreds of millions of ounces on its balance sheet. At the same time, the bank traded silver for its own account and maintained the largest private hoard anyone could identify.
The legal documents that govern the fund allow sub-custodians, and in stressed conditions, they permit cash settlement rather than delivery. In other words, shareholders believe they hold physical metal. Legally, they hold a claim against a custodian that also trades and stores the metal. That tension mattered as inventories thinned. By 2024, the incentives had shifted again. The same institution that paid a near billion-dollar penalty for manipulative trading now published bullish research on silver, forecasting a catch-up where silver would outpace gold. Analysts at the bank argued that structural deficits would push prices higher. For a bank that accumulated metal while prices were suppressed, the potential for profit was clear, whether from trading, research positioning, or balance sheet appreciation. The arithmetic tightened. The gold-to-silver ratio, historically near 60-1 over long periods, sat nearer 80-1 during this phase. If gold held at certain levels and the ratio reverted toward historical norms, silver prices implied could move dramatically higher. Independent analysts began to publish targets well above prior ranges, scenarios where inventories hit critical lows and prices spiked. The deeper problem is that silver supply is fundamentally inelastic in the short term. Mines take a decade, often two, to develop. Most silver is produced as a byproduct of copper, lead, and zinc mining. If those primary metals don't justify new investment, silver output rarely expands to meet surges in demand. Meanwhile, demand drivers, solar and EVs, are structural and growing. Even a sustained price rise is unlikely to prompt a quick supply response. So the market reached a point where the paper suppression, the efforts that kept prices muted, collided with the physical reality. The metal was simply being consumed. Positions that once protected against price moves became the basis of a vast physical holding. Whether by design, by opportunism, or by accident, the bank found itself positioned before a squeeze. The traders were convicted. Sentences handed down. Litigation continued in other arenas. And through it all, the fundamental mismatch between how silver is traded on paper and how it is consumed in the real world remained. In the end, this is a story about scale and incentive. A single institution's ability to move between paper and physical markets, coupled with the structural demand for a scarce industrial metal, produced a dilemma the market could not ignore. Whether one views it as a masterful arbitrage or the largest manipulation the market has seen, the outcome is the same. A market forced to reconcile what it traded on screens with what can be delivered out of the ground. The silver deficit is structural. Mines cannot be switched on overnight. Demand, from solar roofs to electric vehicles, is persistent. And when the paper market meets the limits of physical supply, the consequences are not measured in headlines alone. They are measured in years of repriced expectation. This is how control, regulation, and technology converged on a simple metal, and how the choices made on a trading desk rippled outward, reshaping markets and exposing the thin line between risk management and market power.